Welcome to Key Points for February. This month, our take on US monetary policy, why we believe equities are going through a bottoming pattern, and an update on our macro views. Now to the first point. The Fed's January press conference appeared to be much more hawkish to some than they had anticipated. The Fed Chair Powell spoke about inflation running at a very hot level on many occasions. He also spoke about the economy running strong and that employment, in his opinion, was at full employment levels. He also discussed about how the $9 trillion balance sheet the Fed has could be worked down. And as a result of all of this, some interpreted this in a very hawkish manner indeed, so much so that some of the investment banks are talking about 6 or 7 rate hikes this year. Now, we didn't interpret it that way. We didn't think there were any great surprises. We believed the Fed had to talk tough on inflation in order to really show that they're not going to tolerate these high levels that we're seeing. But we also believe they're going to be careful in terms of how policy is unwound. Their incentive, we believe, is to move interest rates up first. We think that will happen at the March meeting. They have a window here to move rates higher given the strong growth and the elevated inflation. But we think they're going to be more cautious in terms of reducing the size of their balance sheet. This can be allowed just to simply run off, in other words, not reinvesting maturing assets again. But we do suspect there will be some modest active selling that takes place as well. But we think that will certainly come after rate hikes, and it will be very dependent in terms of market and economic conditions at the time. Remember, we are expecting growth to be slowing and inflation to have peaked by the middle of the year, and we think that will also and should influence their policy decisions. Now, we believe that rates will rise in March, but we are suspecting it's probably going to be 3 to 4 rate hikes and not perhaps the 6 or 7 that many on the banking sector believe to be the case. Now, that's important because it feeds into our second point around equity markets. There's no doubt equities sold off sharply since the start of the year. Indeed, the tech-heavy US NASDAQ is down 17% or thereabout from its November highs. Many other markets are down around 10%, which many believe is this correction territory. Now, given the S&P 500 was up 29% in total returns last year, we don't believe this shakedown is a bad thing, taking the excesses out of the system. But we do believe that we're getting to the point now where it's becoming overdone. The US bull-bear reading, for example, is at the lowest level we've seen in 9 years, even below where it was at the peak of the pandemic. And this implies to us that investors have become really quite pessimistic about the outlook. We're more optimistic because, again, the fundamentals we think are good. PE multiples have come back in quite appreciably. And we think that the strong earnings season that we're in the midst of is likely to rebuild confidence once again. We don't think it's going to be a straight line higher or a knee-jerk jump back up again, but we do think over time we're seeing this bottoming coming through, and we ultimately believe that the market is going to ratchet higher. Also, against credit, there's a bit of a differential has opened up here as well. Equities have underperformed credit quite significantly in recent weeks, and as a result of that, we believe there's potentially a relative outperformance of risk assets of the equity side versus credit in the weeks ahead as well. So fairly upbeat, we believe, for equities, but volatility again should be the order of the day and be anticipated. Now, turning to the macro view, things are looking still pretty strong here. We just saw the fourth quarter readings in many countries coming out. In the US, 6.9% on a quarter-on-quarter annualized basis. Very strong indeed. Looking at Europe, again, a very good picture here as well. The French economy grew by 7% in 2021 over 2020. In Spain, not bad as well, 5%. Germany was a bit of a laggard at 2.8%. But all of that's behind us. As we look forward, we believe the fundamentals of all of these economies remain still very robust, whether it's consumer spending or business investment. But there is no doubt the Omicron COVID variant will have had an impact in terms of the Q1 data that are currently being produced. As a result of that, we think this quarter is likely to be a bit softer before we see a pickup thereafter. Still a very good environment for global growth, significantly above trend, but as we point out, this year will be one where the trajectory of that growth is in decline. Now remember, as always, you can read the full report on zurich.com/MSME.